But we're just getting that MAS decision here. No change coming through to the width and the centre of the currency band. We've also got the MAS saying that it's going to maintain the prevailing slope of the policy band, seeing core inflation as well at 2.5 to 3.5% over the course of this year. So let's get more on this decision now. As we said, it is the first policy decision we have under the new managing director, Chia De-jun, who replaced Ravi Menon in January. Avril Hong is joining us now from Singapore for more on this. So, Avril, just talk us through the headline and the readout on it so far.
Yeah, guys, I think nobody was expecting a change in monetary policy from the MAS at the first of its 4 decisions this year, up from twice a year. And this is, on the back of all 19 economists pretty much expecting it to stand pat. But there are upside risks to inflation. And if you take a look at the core number, for example, in December, that actually surprised and defied expectations of a deceleration. So these upside risks, and given how core inflation is still elevated, is going to be something that we're watching very keenly. And in fact, we are expecting or looking out for clues on where inflation is going to trend this year. How surely the MAS expects these price pressures to come down, whether it's because of declines in import price pressures or whether it's because of the relative loosening of a currently tight labor market. So these are some of the factors that we'll be keeping in mind. And of course, today we're also getting that reminder of some of the upside risks to inflation, the violence in the Middle East, how that's going to play out in oil prices, how is that going to affect shipping rates, and domestically as well, there are some concerns. If you take a look at the GDP print for the 4th quarter of last year, that surprised to the upside. And as I say, the labor market is still relatively tight. We also had a GST tax hike that kicked in at the start of this year. So there are all these factors at play that could pose upside risk to inflation going forward, hence the need to keep things restrictive. But again, as I say, no change for now.
Yeah, the GST sales tax going up from 8 to 9% at the start of the year, as you mentioned there. We've also got the Monetary Authority of Singapore saying it sees growth for 2024 between 1 to 3%. What are the risks around this number?
Yeah, we actually saw that GDP print coming through in the 4th quarter of last year because of the pickup in manufacturing and construction. And manufacturing is expected to continue rebounding this year. So that could mean more of a balanced recovery when the revenge spending for the services sector starts easing off. We're also expecting some tourism arrivals in China to improve, especially given the visa-free arrangement that kicks in next month. But to your question about the risks for growth, they abound. Whether you're talking about China or the 2 hot wars, these are all factors that could prove to be headwinds and could make the external environment less favorable for Singapore, especially given how trade dependent it is. GDP this year is really going to depend on the recovery of global trade.